Welcome back to your F8 trainee videos. We are going to deal in this session with subsequent events. This is again a particularly favorite topic of the examiner because it's quite frequently poorly answered by the candidates. It's assuming some kind of previous accounting knowledge of the candidate. Note that. Pure knowledge questions must not be ruled out here. The attraction of this syllabus area to the examiner has perhaps always been the fact that this is an area which readily lends itself to a very practical scenario-based question. So I wouldn't expect purely a theoretical question on this topic. What you need to know: what is a subsequent event? Basically, a subsequent event relates to events occurring after the accounting period end, but before the formal approval of the financial statements by the company's management. This is a definition given by the accounting standards. This is something you have to know. Now, in terms of subsequent events, there can be two types of events. One of them are adjusting, one of them are non-adjusting. The adjusting events are those that relate to an item or a condition existing at the statement of financial position date, so at the reporting date, where the subsequent event assists in forming an opinion as to the amount properly attributable to such item or condition. Okay, because probably at the date when the statement of financial position was issued, there was some doubt about the value of that particular item. Yes, so the adjusting events just provide more details about an event that was known at the moment of issuing the at the reporting date, but now we have more information about that. For example, making a provision or an adjustment for a client that's gone insolvent. At the date of the year end, they are unpaid items and unpaid balances related to that client. So the fact that he went on insolvent, that's beginning liquidation, now we know more information about it and we are providing for it, we are adjusting the value. Non-adjusting events are the ones that do not alter the year-end position, but which would have had a material impact on the financial statements if they had occurred prior to the year end. Yes, but they do not alter because there were no indications of these events before the year end. These events are usually communicated in the notes to the financial statements. For example, destruction by fire of a warehouse. Auditors have to give careful considerations to those events which at first sight might seem to be non-adjusting, but they might have an impact on the going concern of the company, and as such they could mean that need to be treated as adjusting events. Now, in terms of the auditor, we can discuss about something that's called proactive period and reactive period. What are these two things discussing about? I'll just make a short graph here for you. Let's say this is the year end. This is the timeline. Yeah, this is the year end of the company. This is where the company is, or the auditor is signing the report. So there is an audit report signed. There is a financial statement being authorized for issue. Yes, and there is an AGM. The companies or the auditor's proactive period or active duty is up until he signs the audit report. During this period, they must be proactive in seeking out audit evidence relating to subsequent events in order to consider whether the client has dealt with it in a proper manner according to the accounting standards. There are some I'll highlight also this one. There are some typical audit procedures that would be required to be performed at this level. For example, during the period, they should discuss with management and they should perform subsequent review of company's procedures for dealing with subsequent events. They should examine minutes of board and work committee meetings. They should review management forecasts, budgets, and management accounts to see whether they have foreseen something for the next period that had occurred, for example, after the year end, and that effects are going to be reflected in the next year. They have to pay attention during their routine audit work that is carried out for indicators of subsequent events, for example, tests relating to sales and purchases on cutoff, because these can bring some relevant information to light, and they could obtain management representations also that are during which or through which management is declaring that nothing happened in the active duty of the auditor. The reactive period is after signing the audit report, so it is basically that's something that is here. That what we call the passive duty of the auditor. So this is the passive duty of the auditor, and the auditor in this period shall be reactive to subsequent events. He has to be, if there's some late event in which the auditor had known about earlier and would have impacted the financial statements, then he must react on taking appropriate action. What would be an appropriate action? Now that depends. He probably has to discuss with the management on the proposed reaction. He must consider the revision or withdrawal of earlier report. He must address the annual general meeting, and probably he has to seek for further advice in such situation, and that further advice would include most probably legal advice. Further actions, as just we discussed in the active duty, if you go back to the active duty, actions that the auditor should take, probably she should discuss with the management and ask them to revise the financial statements. If the client updates the financial statements, the auditor can give, obviously if there's no other considerations, a clean audit report, an unqualified audit report. However, if the client refuses to change the financial statements, the auditor must qualify the audit report. In terms of the passive duty, the auditor first probably has to discuss with the management, review the financial statements in terms if they are not issued yet, to ensure that they are revised, and maybe redraft the audit report also. If the client refuses to amend the report, then first of all he should seek for legal advice, probably attend the annual general meeting, and if necessary then resign, because there's obviously a conflict between the client and the auditor. After the financial statements have already been published and something comes up in the reactive period, in the passive duty, he shall again discuss with the managers and with the directors to recall the financial statements, because if they have been issued already, they must recall them. They must review the financial statements, and they must ensure that they are revised. The auditor has to redraft the audit report if the client, or should redraft audit report. If the client refuses to do this, then again probably seeking legal advice and attending annual general meeting, and eventually resigning would also be an option for the auditor. In our next session, we are going to discuss about the last two chapters of our notes, respectively going concern and a short recap on corporate governance. That pops up from time to time in the audit and assurance exam also. So see you there.